Across to the IFL conference where Jim Walker is addressing the press.
An Indian politician, is that who you're giving me up for? Sorry. So, you'll see from the title of this presentation, 2012, the Year of Reckoning, that it was the title of our year-end report that we published in December. We weren't looking at such a good outlook for 2012. Of course, those of you that were here last year will know that we weren't looking at such a good outlook for 2011 either. But so far, this year has proven us wrong. In fact, I'll show you how wrong. Because if you look at that investment strategy, which is our global strategy, it's not exactly doing that well. We would have lost people a lot of money in the last 2 months had you just begun to follow us at that point. Of course, in a lot of respects, this is just a bit of give back from the excellent performance of the portfolio through 2011. But we always start again every half of the year, from the end of November to the end of May, and then same again, because we reckon that fund managers will only judge us on the basis of our recent past performance rather than long-term past performance. But as I say, if you look at that, there's an awful lot of negative signs in terms of the trades that we've got on. And we update this every month. We look at it and we decide whether or not we're going to change it. And by and large, we're quite happy with the recommendations that we've got just now. But the good news for you, if you want to start taking those recommendations, is that some of them are about 20% cheaper than they were when we first made them. So you get a very good chance to get in at the bottom, if you think that this is the bottom. 2012 has obviously started with a bang as regards the performance of markets and as regards the performance of risk on. I want to caution you about risk on, because I'm afraid what we're seeing is just a rerun of what we've seen on various occasions over the course of the last 4 years since the global financial crisis began to hit. And that's that we've got a liquidity rush going on in markets. This liquidity rush hasn't quite come from Ben Bernanke. This time it's Mario Draghi that's really supplied the money and the support to markets, the support to psychology, as he's tried to bail the Eurozone out of its problems. I think eventually Mario Draghi will be seen as Charles Ponzi, another Italian who didn't do so well in the 1920s in America, just like Bernanke will eventually become associated with the Mad Hatter who appears in Alice in Wonderland, written by Lewis Carroll, not even in the last century. These guys are one-trick ponies. All they know how to do is give money to banks, and then the banks use that money to buy government securities. And with those government securities, the yields come down and everybody thinks, oh, the world is fine again. But I can assure you, the world is far from fine. There are good parts to it. A lot of them are in Asia. But there are bad parts as well. So let me start with the worst part, which is Europe. And despite the fact that Europe is leading the rally just now in terms of the introduction of new liquidity to the banking system, let's be very clear on this. The worst is still ahead. And the worst will actually be hitting this year. We don't need to wait for a long, long time to see that. Deleveraging is going to be a major feature of the European economy this year. And with that deleveraging and with the austerity programs that are going in place, so too will a recession be a major feature. Just bear one thing in mind when you're looking at European equity markets just now, which if you look at the Bloomberg page that I always look at, WEI, which just gives you a quick summary of how markets are doing so far this year. Europe is a sea of green. countries, regions, companies that are moving into recession, when their corporate profitability starts to fall and drop like a stone, never end up a year in the green. Regardless of how bad it was last year, it's going to get much, much worse this year. And I'll show you why in a second. The US, I've got to say, is certainly resilient, and it's actually started to pick up again. Again, I'm going to show you why in a couple of minutes. 2.5% growth, I think, is certainly quite possible this year for the US economy. And that's going to be astoundingly better than Europe. So to a certain extent, I think the markets in the US actually do reflect reality. The equities have got a good chance of outperforming, very good chance of outperforming on a global basis this year, but actually are doing reasonably well. There's no recession because profits are doing well in the US. No recession signalled, certainly not before the second half of the 2012. I'll explain to you what that last point means. The curly Ds are beginning to dance just in a couple of minutes. Let me start with the picture of what is happening in this whole crisis. And this is a long-term picture. It doesn't look like a very long-term picture. It's only the last decade, but it's a long-term picture in terms of what we're going to do moving forward. These two charts show you the amount of bank credit in the two systems of the US and Europe as a percentage of their GDPs. These are charts that we use all the time at Asianomics to look at the credit cycle and to see how economies are performing in terms of their ability to take up credit and then drive economic growth into a boom phase of the economy. Since the crisis began, the US has done, as usual, a pretty good job of getting its leverage down. What that chart on the left-hand side shows you is the US bank credit relative. The red line on that chart is essentially the credit cycle. It shows you the dropout from the trend growth of credit as a percentage of GDP over the last 10 years. What we've always found with these charts is that once you get below 2 standard deviations from trend, or in a boom time, once you get above 2 standard deviations from trend, economies and the companies in those economies begin to change their behaviour. So at the moment in the US, with that residual being 2 standard deviations below trend, what we would expect to see is that the demand for credit begins to even out. There won't be much more deleveraging in the US economy over the course of the next few years. They've done the hard bit. There won't be very much re-leveraging, as I'll show you in a second, but the deleveraging process is over. So the real downdraft on economic activity is finished. It hasn't really begun in Europe. And that's what the chart on the right-hand side shows you. Yes, the uptrend in credit as a percentage of GDP has stopped. But if you look at the actual numbers for Europe on that right-hand side chart, what you'll find is that the private sector in Europe has deleveraged from about 145% of GDP at the peak, just before the crisis onset, to 142% of GDP now. In other words, it hasn't deleveraged. And you can see from the residuals, they're just slightly below 1 standard deviation from trend. They've got a long, long way to go before European companies, before European households will begin to feel confident again in their debt levels and begin to get to a point where they have deleveraged enough to start stabilising their companies. So in our view, there's a huge deleveraging process still to go on in Europe. And we think that's hitting this year for various reasons in the banking system, as I say, just to join in with the austerity programmes. The path that lies ahead for both of these regions is shown by these two charts. I could have used other countries in Asia, but for the sake of just putting them a couple of charts on the page, we've got Malaysia and Japan here. What I want you to note is the slope of the line of the trend growth rate in credit as a percentage of GDP. And then check it against the slope of the line for both Europe and the US. After a financial crisis, and after a major balance sheet financial crisis, attitudes to debt change. But they don't just change for a year or two. They change for a decade or two. So in Asia, places like Malaysia, up until about 1997, you would have seen exactly the same trend line in credit as a percentage of GDP as you see for both the US and Europe. An upward sloping trend line, significantly upward sloping trend line, signifying great confidence in the future, everything rosy, and companies and households willing to take on lots and lots of debt. Now look at it. 10 years after the Asian crisis, Malaysia's trend line is downward sloping. At the moment, the uptake of credit is better than it's been over most of the last 10 years, but remember, Malaysia has been doing okay for the last 10 years. Japan, not quite so okay, but that same kind of picture in terms of the trend on credit as a percentage of GDP. It just levels out and stays there for a long, long time after the crash. As I said to you before, Europe hasn't even really had the crash yet. But what that then does is it changes the degree of growth that we get in the system. PIMCO have referred to it as the new normal. And that's really what we're going to get. We're going to get, instead of 3.25% GDP growth in the US as the average over the course of the cycle and over the course of maybe the last 20 years, if we're lucky, 2, maybe 2.5. And that will be the US contribution over the course of the next decade. That'll still be okay in terms of global growth, but it means that the growth rates throughout the world should be readjusting, and therefore also the corporate earnings perspectives readjusting to this new reality. Remember, Europe in the run-up to the crisis was only growing at 2. And of course its average growth rate over the previous decade. It's still got to come down from there. This year our view of Europe is that it will be running at between -2 and -5 in GDP terms. The OECD thinks it's going to be -0.2. But that's the norm for official bodies that are beholden to the governments that they're actually forecasting. They never actually forecast anything out of the ordinary. So even -0.2 for the OECD is telling you this is a major problem in Europe. But it's nowhere near the reality. Why is it nowhere near the reality? Well, this will be difficult to see, I would expect, from far away in terms of the numbers. But what these two charts show are some of the real problems that Europe has just now. It's not just about government debt. In fact, in our view, it's really not about government debt at all.